Have you ever wondered how an entire nation's currency can suddenly plummet in value, sending shockwaves across the globe? It is a complex process often rooted in seemingly stable economic policies that eventually buckle under pressure. The primary trigger for the Thai Baht's collapse, which sparked the 1997 Asian financial crisis, was the decision by the Bank of Thailand to abandon its fixed exchange rate regime against the United States dollar on July 2, 1997. This move came after months of intense speculative attacks on the currency, draining the nation's foreign reserves. Thailand had maintained a fixed exchange rate, or a peg, to the United States dollar for many years, which provided stability but also made its exports less competitive as the dollar strengthened. Simultaneously, significant capital inflows, largely short-term foreign loans, fueled a domestic real estate and stock market bubble. The fixed exchange rate encouraged and hedged foreign borrowing because local companies believed the baht's value would not change, masking the true risk. As concerns mounted over Thailand's growing current account deficit and the quality of its financial sector assets, foreign investors began to withdraw their money, initiating the speculative attacks. Understanding this event helps us identify vulnerabilities in other economies. It highlights how maintaining an overvalued currency, especially with substantial short-term foreign debt and a weak banking sector, can create immense pressure. For policymakers, it underscores the importance of flexible exchange rate policies and robust financial regulation. For observers, it teaches us to look for imbalances in trade, foreign reserves, and domestic asset markets as potential indicators of future currency stress. A key concept here is the impossible trinity, or trilemma, in international economics, which states that a country cannot simultaneously have a fixed exchange rate, free capital movement, and an independent monetary policy. Thailand essentially prioritized a fixed exchange rate and free capital flows, sacrificing its monetary policy independence. This made it unable to defend its currency without depleting reserves or raising interest rates to extreme levels, which would have crashed the domestic economy. The sustained speculative selling, fueled by offshore trading in non-deliverable forwards, created a feedback loop that made the peg unsustainable. Ultimately, the baht's collapse serves as a powerful historical lesson in global finance. It demonstrates how a combination of rigid exchange rate policies, unchecked capital inflows, and underlying economic weaknesses can create conditions ripe for a currency crisis, leading to widespread financial instability and contagion across interconnected economies.